Hey guys, in this video I will be going more in depth regarding market makers. More specifically, in this video I will be touching on how the market makers makes a market within the option market. I want to begin by going over the requirements. What I mean about that is that if you are someone who has a lot of money in the infrastructure and the team, you still need to apply within the US to get some licensing before you can actually be a market maker there. We're going to be also looking at the market maker's view in the general market, which is non-directional, meaning that they don't really care about the market going up or down. They are more interested in the volatility being high or low. We're going to be looking at how they actually make profit. We're going to be looking at how they actually calculate and give within the market a bid-ask price, which we then observe and trade on. In the end, we will also be looking at the payment for order flow and how that is and why the market makers actually pay brokerage in order to get the orders from them. Let's begin with the requirements. So you can see right here that you need to become a member of the SRO, which is a self-regulatory organization. You can think of that as it's someone just like the FINRA organization. You also need to register as a broker-dealer at the SEC. You need to acquire the licensing from them. After you get a permission from them, then you are able to actually provide the services of being a market maker, which is basically providing the bid and ask spread. You can execute for clients and your own accounts. You also have some compliance regulatory monitoring that you need to be doing, detect and prevent market manipulation. And then you have the risk management aspect of it, which is more operational driven, that regards to holding of the inventory. Next, I actually want to be looking at the view of the market makers. So that is that they are non-directional. What I mean about that is that they care about the volatility. And before we're going any further, we need to understand what is historical volatility, realized volatility, and implied volatility. Historical volatility is already realized, which means it's basically past volatility that you can find in Yahoo Finance data, for example. And then you have implied volatility, which is backed out from a particular model. It can be other models, it can be the Black-Scholes, for example, and they can be all models, but it's backed out from it. Realized volatility is what you expect the realized volatility to be. So I just have written down here that if the forecasted realized volatility is equal to the realized volatility, then it is the realized volatility. What that means is that if you are able to forecast one-to-one what the future volatility will be, which is quite difficult, then that is the realized volatility, which is important for our later discussions. What's important is that the market maker take the opposite. In general, we think about when we talk about the secondary market that investors are trading with each other always. And there is also market maker to provide liquidity, and they don't really care about buying and selling in terms of where the market is going. They just want to make the market and earn from the bid-ask spread. What that means is that the market maker takes the opposite position. So if a trader shorts a call, then the market maker will be long the call. The market maker doesn't really want to be exposed, so they for actually being long the call, for they are not interested in any direction, so they want to hedge that exposure. How they hedge that exposure is through delta hedging, which is basically which is a change in the option price. Delta is basically the change in the option price for every change in the underlying. So I have just given you guys here 3 methods to do that. You can be dynamic hedging, which you can do a static hedging, and you can do no delta hedging if you want to, if that fits your risk. The interesting part is the how. So that's basically they do that from the money market account, which is the bank, so borrow from. And you can also look at, they also do delta hedging through buying and selling the underlying, and which they actually monitor week after week until expiration. So one important thing is to actually think of the European call and put options. That's what I have in mind when I wrote this mind map. Given that the hedge funds are more a lot of computers and automation going on, so how they actually do exposure their hedges, basically when an order is executed or they make an order or someone takes that order, which is an investor, for example, or a retail investor. The way they do the hedging is through a second trade following the first trade execution, which happens in the back end. They want to neutralize the risk parameter which they are exposed to in the market. So let's go through how they actually calculate and provide a bid-ask spread. So the way they do that is to actually there are different ways that they actually calculate the price, but they actually use realized volatility or implied volatility within the market from the model. That's very important. And then when they are calculating that price, they want to then they can actually give an ask price within the market and a bid price within the market above and below that price that they have calculated. That's very important, and that is done simultaneously. So if you think about the ask price and bid price, their volatility, the ask price volatility will always be larger than the bid price volatility, and the reason being is that if you buy and sell, if you buy at the ask and sell at the bid, you are losing instantaneously. So the volatility of the ask price will always be a bit higher than the bid price. And then the most important thing is that in the end the customer pay what they pay, which means the supply and demand is actually driving the prices, and then you can back out through model or forecasting ability and see what you want to provide the market with liquidity with respect to the ask and bid price in the market. What I want to talk about right now is why it's important for a market maker to forecast realized volatility, and then we should see and how it affects the profitability later on. But right now, if there is a low mean squared error, also the forecasting error is quite low, the market maker will be very confident in their bid and ask prices that they provide, which means they can hedge with more certainty and then have a better probability of being profitable. If it's a high forecasting error, they are less confident with the bid-ask spread that they provide within the market. Now let's see how the volatility affects the profitability of a market maker. So what I want you guys to think of is that we sit down here that if a trader is short the call option, we are long the call, right? So let's use that for this example right here. So if we are long the call option and we buy at a high implied volatility, which is implied by the market, also backed out from our model, point in time, and then in the future, if that when we actually look at the realized volatility, if it's low, then we have a high probability of a loss. And the other way around is that if we buy, again back to the long call, at a low implied volatility, and then at a later point at the expiration sell at a high realized volatility, that is a high probability of the profit. So if you are able to forecast the volatility, you have a high probability of profit, and then if you do that simultaneously over time, you will make a lot of profit by doing that. And then you are actually able to hedge out through dynamic static hedging by actually buying, for example, the underlying. If you think about if you are selling the underlying, also it's a possibility. So if we are long a call option, it means we are positive delta, which means that we should then short the stock, a fraction of the stock, depending on the delta, how many shares should we actually short the underlying in order to actually be to hedge our delta. And the reason is because we don't really care about, or the market maker doesn't really care about which direction the stock goes. They just want to hedge out the directional view of the trade, which they also are in. What's more difficult to actually hedge out is the volatility. So if they have a more or a better forecasting ability of the volatility, then it increases the profitability of the profit. So that's why they are really interesting in forecasting realized volatility. The last thing I want to touch on is the payment for order flows, and that is basically a transaction between the brokerage and the market makers. A good example is between the Robinhood and the Citadel, and there's different structure for different marketplaces, but I have given an example right here that in the New York Stock Exchange they have a maker taker framework, which is basically when they're giving the orders, it's basically accumulated in the order book, and when it hits that price, then it gets executed. The reason why market makers are interested in buying these order flows is because of the volume. It allows the market maker to get enough volume to capture the bid-ask spread. So when they are creating a market, they have a bid and they have an ask. By doing so, they need to actually take some kind of directional risk, because they need to provide it by buying and selling continuously. So they're accepting that risk, but of course that risk varies depending on the product. And then by having, since they earn a profit through the spread, they want to have a lot of volume to earn the most, because a lot of people is then transacting on it, and then they can profit a lot from it. And in doing so, from a competitive marketplace, if they know they have the volume, they can offer narrow bid-ask spreads in the market, which then they make up for by having a lot of volume. So the volume need to exceed a threshold to actually make it more profitable. And what is done in the general market is that it is more competition with other market makers, that you can actually that you already have orders ready to be executed or potentially be executed, because you are buying them orders from, for example, the Robinhood, in order to get a lot of volume for that bid-ask spread that you have provided in the market. So you are increasing your profit through volume. So that's it for right now. I just wanted to make this video. If you guys want to, you can just pause the video, whatever part of the mind map you find interesting, and then if you have any questions regarding it, the market makers more in depth regarding the calculating of the price of the payment order flow, just put it down in the comment section below, and I'll get back to you. Yeah, that's it for today. Hope you guys have a nice day. See you.